Importantly, what is the Fed saying? First, let's provide some historical context on this situation because we've seen it before. We've seen earlier this year actually better than what we got today. We saw inflation in July come in lighter than expected. The market move on that. We also saw in July 0% month-on-month inflation, which is better than we saw today. Today, we saw 0.4% month-on-month inflation, which if you annualize in isolation is 4.8% inflation annualized. 0.4 times 12, 4.8% annualized current change month-on-month based on what just happened. So what's the Fed saying? Because ultimately, this is what matters. The whole market move is based on the assumption that the Fed can now begin to be calm, be easy, et cetera, et cetera, et cetera. The same thing the market has been trying to push down its throat, which has led to these vicious rallies we have seen multiple times. Let's not forget, bear market rallies are the most vicious rallies. Why? Because sentiment is down, positioning is down, cash levels are high, people get excited, they think the bottom's in, they think the opportunity's there, and there's a rush to go in. The sellers, the short sellers in particular, fear a rally, they get some news, they wonder if it's going to extend, and they cover their shorts. I'm one of those people. We got the data immediately. I covered my short on the S&P 500, not my puts, my short on the stock, and I covered my Tesla short. I was afraid. I bought the stock. I contributed to this rally. So, back to focus. What is the Fed saying? The Fed is saying what I have said on this channel, expected them to say. 1 month of data is not a victory. Inflation is still unacceptably high. This is the bad. There's going to be some good. We'll get to the good in a second. Services prices have not come down. There are still risks for inflation to come up. The discussion of pause is still not occurring. These are all the bad things. The Fed did say one good thing, which I think is very crucial and simply can't be ignored. And it seems that 75 basis points, assuming December isn't some tremendously hot read, which is a possibility, and we'll get into that in a second, or November, when that we get in December, they want to slow the pace of rate hikes. They've gone to moderately restrictive. They said 50 basis points is still a dramatic hike. I think that's crucial. I think it's looking like we're going to get 50 basis points in December. But is that all we're going to get? Is that all we're going to get? The Fed's remaining hawkish, but is the market going to anticipate that, inflation is peaking, we've hit the peak, and we're on the downward slope? My answer to that question is, like the Fed said, it's too premature to continue to discuss pausing because there are other risks out there. I think there are other risks out there, and I think they're pretty freaking significant, and that is oil prices, and honestly, more importantly now that we're starting to see some dramatic situations happen, diesel prices. What do I mean by this? For the last, I don't know the exact date, we'll call it 6 months, the government has been manipulating the price of oil lower. It's expensive. It's more expensive than it was pre-COVID. It's more expensive than it was last year, etc. But the price has been manipulated lower through the Strategic Petroleum Reserve. At the end of this month, the Strategic Petroleum Reserve is completely irrelevant. It's completely irrelevant. All of a sudden, you're going to have an artificial supply shock. That's what it is. It's a supply shock. We were currently consuming more than we produce, but we're filling that in with artificial supply, and that is going to go from 100 to 0 real quick. And guess what's going to happen then? We're going to have consumption higher than production. This issue is particularly of concern in the diesel markets where production is quite low. The read we got earlier this week that sent, I believe it was yesterday actually, that sent oil prices lower yesterday, it saw gasoline inventories up, it saw crude inventories up, but it saw distillate inventories down. Distillate inventories down. You know what distillate means? It means diesel and it means heating oil. Two very crucial molecule sets that this economy needs. Diesel is not a very elastic good, okay? You need it to transport goods. Virtually, I don't know if it's all, but a large portion of trucks use diesel. It's more fuel efficient. It allows trucks to last longer. The spread between the price paid for oil, okay? So we think oil prices are going up. They're going to go up. But the spread between the price of oil and the price of diesel is widening. There's so much oil, there's so much oil. The problem is refineries. Carl Icahn was just on TV talking about how his favorite stock is a refinery company and how a lot of refineries have dropped out of the business. The EPA is coming after them. They're making it hard. It was unprofitable for them for a long time. Some decided to keep investing, and they're reaping the rewards of that and will continue to reap the rewards of that. Some of them that I like are trading in low single-digit multiples because nobody understands this stuff. Nobody understands diesel. A lot of people that have a lot of money in New York City, it's completely irrelevant to them. They have no idea. This company, PBF, zero net debt, 2.8 times earnings with a dividend that they plan to hike, want to return all the cash flow to shareholders. I mean, this is an area of the economy that I think is it's misunderstood. It's a problem, in my opinion, because if diesel prices go up, shipping rates go up, and guess what we're doing? We're trying to take production out of China, move it to the United States. We need trucks for that. This is not some sort of, consumption is going to go down even if there's a recession. No, in my opinion, my expectation is it's going to go up. The IEA expect gasoline and diesel consumption and oil consumption to go up until 2035. No new refineries. A couple months ago, CEO of Chevron says he doesn't expect another refinery to be built in the United States. I just talked about how consumption is going to go up. You do the math. You think about this. You have consumption going up. You have no increase in supply. There's no new diesel supply coming online. The Chevron refinery in California was operating at 92%. Guess what happened? It caught fire. All right? We're at maximum pedal to the metal in this department right now. And back to center, inflation. There's a reason why the Fed is not trying to claim victory here, why they're not trying to pause despite what people are hoping. And I understand why they're doing it. But there are reasons not to pause. There are reasons not to claim victory yet. And it has a lot to do with oil. So what do? We're not changing anything over here, okay? We are benefiting. We are rallying when the market's down, and we are still rallying when the market's up. We're up less than the market today, a measly 2.5%, but fine. I will trade a slight gain on these bear market rallies, which we know are very volatile and very strong just based on the fundamentals of positioning, for comfort, for stability, for lack of stress, and for the ability to perform in both up and down environments. So we've talked about it in our past videos. Positioning. Large cash position, it was 30%. To hedge, I took off some shorts that squeezed the cash down a little bit. I also added some longs, bought this refinery, bought some Levi's, which I think is a tremendously priced stock. We just saw Ralph Lauren numbers. They're very good. People are going back to normal dress attire. I think Levi's is going to be a major beneficiary of that. Fantastic product. Price of cotton has come down dramatically. I really like Levi's. Palantir, bought some of that. I've done some nibbling the past couple days. So that 30%, it's now looking more like 20%. 20 to 30% cash, 30% energy, 30% shorts and other bets. I added a short, Chipotle. This is my mix. It's performing well on up days. It's performing well on down days. I'm having a tremendous year, and I expect this to continue. Can the market rally continue? Yes, it can. This is a tremendously strong day. We have to take that in solidity. We also have to look at where the market is overall. The Dow is down less than 8% for the year. At one point, this was the worst start to the year in history. We've seen the 10-year Treasury go from less than 1% to 4%. Now it's down to 3.8, which I think is too low. Outside the scope of this video, I think you can understand why. The Fed is hiking. Real interest rates need to be real. They need to actually offer a return for giving up your cash now, because you could otherwise do anything else with it. So they can't be zero interest rates. That is not a good idea. Jamie Dimon has said that's a doomed to fail philosophy. So interest rates are up. The market's barely down in some areas in the Dow, overall index level. The S&P 500's up nearly 12% from the lows. So this is not, we weren't at a bottom this morning, okay? We have added to a strong move, a relatively strong move. I'm not trying to say it's doing as well as the Dow. Nasdaq up 7% today. It can go on for a little bit, but we are approaching, we're right on the tip. We're basically making out with S&P 4,000. Can we get to 4,100? Possibly. All-time highs like 4,800. We're really getting close to that if we go too far. So all the reasons outlined in this video, what the Fed's saying, diesel prices, oil prices, the Fed not pivoting on this information, all reasons to keep the portfolio construction. So that's today's video, and until next time, peace out.